Hello, everyone, and welcome to Powering, Financing, and Building the Future of Data Centers. I'm Fernando Sosa, Managing Director of our Energy and Infrastructure practice here at Marshall & Stevens, and I'll be moderating today's discussion. So as we all know, data centers have evolved into complex, energy-intensive infrastructure hubs. They're no longer just about servers and storage. They're about location, strategy, power availability, cooling efficiency, and connectivity, all factors that directly impact both cost and performance. Today, we'll explore how developers and investors are tackling these interconnected challenges and what strategies are driving the next phase of growth in this sector. I'm delighted to be joined by an exceptional panel. We'll start off with Mr. Chuck Miller, President and CEO of Injex Energy, which provides resilient and cost-efficient power solutions using clean energy, CHP, battery storage, and financial structuring. Next, we'll be followed by Akash Deshpande, founder and CEO of SkyBlue AI. SkyBlue invests in AI infrastructure to accelerate capacity, delivery, boost performance, and reduce costs. Next, we'll be joined by Mr. Anthony Festa, National Practice Leader, Machinery Equipment Practice at Marshall & Stevens. We are an evaluation and litigation support firm offering opinions and analysis and expert testimonies since 1932, the oldest appraisal firm in this country. And then we'll be followed by Mr. Paul Costanzo, sorry, Paul, Director of Mission Critical at Kais AR, which designs modular factory-built data center systems for telecom edge and hyperscale AI deployments. And last but not least, we'll have Mr. Dino Barajas, Chair of Project Finance Practice Group Americas at Baker Botts, a global law firm with strengths in energy, technology, intellectual property, and complex litigation. So we'll go ahead and get started. So our first theme is about where and how data centers are developed. Site selection is driven by power availability, cooling needs, and connectivity. We'll also touch on taxation, insurance, and key markets. So we'll start off with Dino. From a project finance and legal perspective, what are the biggest drivers you're seeing around site selection?
So the most important thing, of course, is going to be power availability, connectivity to some of the fiber superhighways, and then water availability. And then before selecting any particular site, getting a tax abatement agreement in place. So, the first thing anyone needs to do is keep everything under wraps before you announce where you're going to set up your tent, because it's always going to be critical to end up with as much tax efficiency in terms of what you're creating from an economic development point of view. Everything builds on itself, so making sure that you have a strong foundation to build on, meaning your site, but more importantly, you're only as strong as the weakest link in your chain. So making sure power availability, interconnection to the electrical grid, water availability, and as mentioned, access to the fiber superhighway.
Excellent, Dino. Thank you. Thank you so much for that. Chuck, how does power and gas access factor into those decisions and long-term infrastructure planning?
Sure, thanks. I guess, to add on to what he already said, in addition to power and fiber, if you're going to be doing, either bridge power or if your expectation is to leverage natural gas for backup generation, your connectivity to gas and gas availability is also a key component in your decision making. So, in your locational thinking, now they've added this to the mix where it used to be just, I need grid power and I'm going to use diesel for backup. Now the natural gas and the availability of natural gas becomes a key component in your decision factor. So you have to look across the board at what is going to be involved and what your strategy is going forward. In many locations, grid power is 3, 4, 5, sometimes 7 years out, and in those instances, if you're looking at, getting to market as quickly as possible, you're going to have to leverage on-site behind the meter generation until the grid becomes available. That's, what they're calling bridge power. So it adds a new wrinkle into the overall equation.
Well said, Paul. Well said. Sorry, Chuck. Well said. I completely agree. Paul, site selection often comes down to aligning with future scalability. Where do you see the biggest opportunities for collaboration between developers, operators, and manufacturers to reshape the data center ecosystem over the next 5 years?
Yeah, Fernando, thank you. I think the beside what Chuck said about the bridge power, I think the thing that we're seeing most common is clients aren't sure what rack density they're going to use. Right now, the average rack density in the US somewhere 14-ish kilowatts. And so we want our facility to maybe day one to be 20 kilowatts per rack, but we want to allow for either future power that's coming 5 to 7 years down the road, or we don't know how much AI we're going to invest in. We're not necessarily going to go to the NVIDIA GB200 racks right away, 132 kilowatts. So our clients are looking for flexibility where they can have, 10 to 20 kilowatts per rack day one, but then allow them to phase up to the higher density racks as their needs progress.
Thank you, Paul. Akash, this one's for you. Managing long delivery timelines has become a major challenge for developers. From your vantage point, how can the industry better manage those delivery constraints?
Thanks, and thanks also for organizing this wonderful panel. Yeah, the data center builds are complex and multi-stage projects. They take a long lead time. And especially, traditionally it was managed through long-term forecasting by various enterprises and hyperscalers. But over the last 2-3 years, with the AI boom, all the demand forecast models have gone out the window and people are scrambling a lot. The way I like to think about it is to break down the data center development project into multiple stages. So what is called pre-development or concept phase, you're gathering land, power, water, fiber, construction crews, various partnerships, acquiring customers, and fundraising. So in this phase, a lot of the regulatory things, a lot of the aligning all the resources to come up at the same time is what takes a long time. Then once you start facility development, getting the permits and plans, etc., the long lead time there is all the facility equipment, such as generators, turbines, switchgear, chillers, and so on. So getting into that supply chain and forecasting that well and getting your slot secured is very important. Then you go into the IT development phase, and access to IT equipment and supply chains, especially GPUs, becomes the long pole in the tent. And then finally, even when you're serving, managing failures and redundancy and restacks and optimizations of the infrastructure can take time. So I think the way people manage is breaking this down at different stages and building inventory for the different parts. And it costs money to maintain inventory, but then how do you manage that? How do you keep whatever is expensive for a much shorter time in your inventory? That's how you manage.
Well put. Well put. Agreed. I'll direct this next question to Paul and Akash. What markets or emerging corridors are you watching as a growth hotspot?
Go ahead, Akash.
All right. Well, I think with the AI boom over the last 2-3 years, US has taken the lead a lot of infrastructure development and investment is happening in the US. The rest of the world is catching up now. I would say going forward, it might be half and half, US and the rest of the world. I think what is driving regionalization and diversification of investment is data sovereignty and sovereign strategies of various countries and regions for their industrial competitiveness, for their citizens' privacy protection, and so on. So I think we will see continued investment across multiple areas of the world. The other thing I'm seeing also is there are some regions that are very energy rich, power rich, but may not have a native need for so much data center investment, but they are creating sovereign domains within their countries to serve other countries so that the other countries' rules and regulations can apply within their region. That's some of the moves that I'm seeing.
And Paul,
Yeah,
any
yeah,
follow-ups?
yeah, I would say I agree everything with Akash. I think in the US, the interesting piece we're seeing is more novel power distribution. So there's a few hydrogen hubs in the US. There's a few sites there where there's going to be on-site power generation using hydrogen. Natural gas, Chuck Miller can talk more to that, but the locations that are close to natural gas. And then also adjacent to Department of Energy land with small modular reactors that are probably going to pop up first on these Department of Energy lands. So the land adjacent to that, we're seeing more inquiries into do our data centers, can they integrate with these more novel power solutions? And so we're seeing those areas pop up.
Very good. Thank you both for that, for those comments. Excellent comments. Tony, Dino touched on this lightly at the very beginning of this webinar. So I'll bring this question over to you. With respect to ad valorem taxes, insurance for real estate and fixed assets, they can make or break the economics of the project. What considerations should developers and investors keep in mind in this area, in this space?
No, great question. Thanks for having me, Fernando, today. So we'll take those one at a time. When it comes to insurance, let's remember that insurance deals with replacement value today. My message to owners and operators, especially their finance teams, would be that if you're building a data center now, great. Hold on to those costs and be ready to consistently and constantly update those costs, especially if you're wearing the risk manager hat. If you're in an area that's prone to flooding, tornadoes, et cetera, and again, who can ever predict a fire, gosh forbid, it helps to have a current insurance appraisal on hand and in a safe place in case you have to utilize it. And, insurance premiums and costs come down to, what's the famous saying in real estate? Location, location, location. You want to know where the costs are going to be greater in certain areas because of those premiums. It's going to be more expensive to build a DC within a 30-mile radius of New York City than it would be to build it 30 miles outside of Lincoln, Nebraska. The other portion of your question, Fernando, goes into ad valorem tax. And again, thinking about location, 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 let's all remember in all 50 states, there's tax on real estate assets, but not all states. Most do have tax on personal property tax states. One of the hot topics in ad valorem property tax right now is, think of the word pilot, which is payment in lieu of taxes. Now, what is that? It's a contract between taxpayers and the local jurisdictions where that taxpayer will pay an amount now to hedge against or guard against property tax increases. And that contract could be, anywhere negotiated between, 1 year, 5 years, again, with the jurisdiction. My message to developers is when you're putting a project into play, typically when you start going through the permitting process, speak with your assessing jurisdiction to see what's allowable. Jurisdictions need money up front to pay for, schools, fire, police, what have you. If they can get that money up front now, and you can, as a taxpayer, defer taxes down the road, it's a win-win for everybody.
Well put, well said. Dino, it was really eloquent how you started the entire webinar off with taxes and in mitigating those liabilities. Any additional comments you'd like to add with what Tony just mentioned?
No, I mean, it's just critical as you kind of think about your development to make sure you think through the entire value chain. So I mentioned tax abatement. Everybody wants to wave their flag. Everyone wants to make the announcement. In some cases, with the ultimate end users, everybody is fundraising. They're, making sure that everybody sees them as the leading horse in the race. You have hyperscalers trying to come to market, waving their flag, trying to, be the biggest kid on the block and corner the market. And then, you have, the power producers and they're coming to market. And in the past with the data center development, you were able to, do much smaller, 50, 100 megawatt developments and just simply apply for interconnection, which was pretty straightforward given, you weren't going to really move the needle. And you were able to essentially utilize reserve margin energy. So again, what was already available on the market, as I think someone stated, and just simply pull energy that was already available as a cushion. So it didn't move the needle. There wasn't a lot of concern given to that. And even the water needs, weren't as critical. Now, of course, you're starting to see gigawatt plus developments, multi-billion-dollar financings being raised for all the ultimate end users. It's mission critical. So as clients have told me, this is an existential milestone for us. Failure is not an option. So again, choosing the right partner, making sure that everybody around the table in terms of these consortiums that are being put together, that they're being put together thoughtfully. Some of these consortium agreements that we're working on, there's a lot of players around the table. Everybody has their own interest, but making sure that there's somebody trying to coordinate everybody to get to the right answer to do this all in a timely manner. And again, because failure is not an option for anyone in these consortiums, making sure that everything is well planned before you even begin execution, and more importantly, before you begin your announcements. Because again, it's great to get all the fanfare, but more importantly, you need to have all your ducks in the row and figure out, what your power plan is going to be, what your water plan is going to be, what your financing plan is going to be, and then reaching out to people early on in the process to make sure that everybody's needs are met, because you could always modify things down the road. Everybody's happy to go back and renegotiate agreements, but they're going to extract a pound of flesh, and they're going to ask for their own needs to be met to accommodate, whatever last minute ask may come to the table.
Well put, Dino. Well put. Yeah, I'm sure you and I have both been in situations where people have waited until the last minute and things typically don't end well. Chuck, Paul, Akash, any comments on what Tony or Dino had to say with respect to taxes and insurance for real estate and fixed assets with respect to these projects?
I wanted to add, right now, as you look at the change in the way the data center environment has evolved, you're adding, $700 million in capital cost, in the power plant. Before, all you were doing was building a data center and using, diesel generation for backup. Now you're building effectively a power plant that's, equivalent to grid scale power plants. That cost is significantly adding to your tax base, the capital outlay, and your exposure, because there's a lot of different risks associated with operating a power plant as opposed to operating a data center. So that consideration really needs to be thought of upfront in this whole upfront planning that we were discussing.
Well put, and I agree. I mean, these are large scale utility scale power plants. I mean, these are not small power plants. So I completely agree. Paul, any comments?
Yeah, I would see the other area to consider from the insurance is, you talk about a traditional air-cooled rack, 10 kilowatts, it might be 10, 15, $20,000. You talk about a liquid cooled rack, high density, GB200, you're talking over $1 million. And so all of a sudden now the IT is almost as valuable as the power and cooling infrastructure. So I think that we've had a few clients that were surprised by that. They didn't realize how quickly the IT price has gone up as the density has gone up.
Yeah, you can think of it as, do you have a data center attached to a power utility or a power utility attached to a data center? And probably many laws will reflect that, like in times of power scarcity, they might want power from the data center to power homes and stuff. Anyway, I think the other aspect also is incentives that various regions offer, and to be able to tap into them and use them judiciously. And I think in terms of at the regulatory level, the utilities and the governors of them, basically elected officials, are trading off. Okay, do we need to provide power to our citizens at a affordable rate, or do we have access to give to data centers, and what is the balance of these two use cases? So I think that will be kind of discovered as we go along, as we invest in this power infrastructure.
Hey, Fernando, one thing to add, and I think a
Sure.
service that Marshall can really assist clients with is as we're discussing the building of all this infrastructure, and I think Chuck mentioned some of the timeline for development of massive natural gas powered new generation may be 5-7 years off because there's a scarcity in terms of turbine supply. There's a construction milestone schedule that even once you have a turbine, you got to negotiate the EPC contract. You have to find your site. So rather than complicating what's already a complicated process here, you may want to look at what opportunities there may be to simply acquire existing assets in the market. So I know there are a number of generating assets that are popping up every other week that are now on the market. They're up and running, but that's where a Marshall and Stevens may come in, help you do an evaluation, put in a bid, and you've just checked off a massive box where you're not having to share someone else's dream in terms of new build for new gas-fired generation, but you simply figure out where there's already an existing power plant available and see if that works where you need your supply and where you're already planning to build your gigawatt plus data center. So it's one way of getting ahead of the game, taking out another set of risk factors that may complicate the building and the financing of a massive data center by already buying something that's in the market. But again, having your team already earmarked these opportunities come quickly into the market. Everybody's trying to capture all the enthusiasm in this area, and making sure that you have the right team of consultants, advisors already on your team is job one, because when the opportunity presents itself, you need to move quickly and decisively.
Another alternative development strategy is, the data centers have been developing stage-wise for decades, right? They build a 20 megawatt or a 10 megawatt model, and this fits nicely with what Paul is doing in the modular construction. We're seeing that same modular construction, modular packaging around the power assets. So the idea then is to, if you're building a 100 megawatt facility, bring your first 10 megawatts online as quickly as possible, have it start generating revenue, have it operate independently from the rest of the data center, and your next 10 megawatts, and your next 10 megawatts. And it actually fits in line with the procurement strategies, because of the delays and the timelines associated with, allocating equipment. Getting your first assets up and running and generating revenue becomes, a key differentiator. And, with the modular manufacturing that Paul's team is bringing to the table, the modular packaging that we're seeing in the power sector, particularly around small engines. Now, it used to be where you had to buy a big LM 5000, and generate 50 megawatts at a pop. And, when you're using generation behind the meter as your primary source of power for any number of years, you don't want to have a $50 million asset that's just sitting there as backup. So we're starting to see the configurations downsize into smaller form factor, smaller engines that are packed together, grouped together in what I'd call power blocks. And then the redundancy that's required to maintain an M+1 or an M+2 strategy is at a much lower cost. You're not having a 50 megawatt engine, you're having a 5 megawatt engine as your backup redundancy strategy. So, being able to modularly package the power solution with the data center solution is an alternate to, again, going out and buying assets that are operating and running. It's just another approach to development.
Excellent. I would absolutely agree with that, and I would just add one little point to that. And when we're looking at the appraisals, right, and we have a capex of $1.4 billion taking place within year 1 and 2, that has a pretty serious effect on the outcome of the appraisal, as opposed to spreading this out throughout several years, as you mentioned. So very good point, Chuck. Very great point.
And just
go ahead.
because I can't shut up on this. The other piece that's interesting is, you know, when you look at building plan now, we're taking of having
We're
a third
we're
party
losing
take
you.
control
We're
of
losing you,
assets.
Chuck. We missed that last piece. We lost you there a little bit.
Oh, sorry about that. Can you hear me okay?
Yep, I got you.
Okay. So what I was saying is that on the power side now, you know, they're incorporating assets in their construction piece that could be financed through a third party, all the way down to the PDU level. So the switchgear, the transformers, all of that was previously on the data center side of the ledger could now be, you know, farmed out to a third party under an energy services agreement that's going to reduce the amount of capital on the data center side. It's going to increase the amount of capital on the power plant side, but it's, you know, de-risking the data center in that that effect, and putting power generation and power distribution assets in the hands of the experts on that side of the equation. So another piece that can affect the overall financing strategy.
Well put, well said. We'll move on to the next topic. Location is critical, but the first step, once a developer's picked their site, the next big challenge is going to be powering this, which we were just discussing, right? So this takes us to our second theme. It's going to be energy supply, cost, flexibility. Energy isn't just about having enough power generation or electric generation. It's about cost control. It's about reliability, flexibility, behind the meter solutions, interconnection into the grid. Power purchase agreements are now an essential part of this development strategy. So Chuck, we'll go right back to you. What are you seeing in the behind meter power approaches, and how are they being integrated into data center projects?
You know, to this point, most of the data center operators have said, I got to have grid power. I got to have grid power. And, you know, that's been their only approach. But now as power becomes more and more scarce, they're starting to broaden their thinking. Well, now I can do bridge power. And, you know, so they go and they search for areas where they can put power in and generate their own power. But if you're, as I said before,
Sorry, Chuck, losing you again.
as bridge, if you're generating power, you know, as bridge power for 5 years, well, that's primary power. So I mean, you know, they've evolved their thinking to the point where, you know, all right, the next step is going to be that, hey, maybe I'll get on-site generation as my primary power and use the grid as backup at some point when it comes. And you know, if you see power prices are spiking through PJM actually around the country, the cost of natural gas has stayed flat or even lower. Dynamic, reducing the cost of natural gas. It could very well be that 5 years from now it'll be significantly less expensive to generate on site than to buy power from the grid.
No, good point. Good point. As energy and cooling demands increase with AI workloads, how are those needs changing the way you design and deliver modular data centers? Paul, I'm gonna give this one to you.
Sure, thank you. Yeah, so we're getting more inquiries about can day one, can I have 10 megawatts of power capability for IT load? And then I don't know when I'm gonna increase my power that I need. So can I have these electrical skids that provide the power? Can I have another set of those, another 10 megawatts a year from now? And so we're getting more folks are looking to defer their capital expenditure, not procure all the electrical equipment up front. Like Chuck was saying, hey, can I get 10 megawatts online day one? get that powered up, and then as I increase my density or scale my site can I get those skids? And so by using this modular electrical skids, it allows you that flexibility. You can design the site knowing that you're going to potentially add that power, but not necessarily having to build out a shell of a building and have that empty shell waiting there, for years while you're increasing the amount of capacity you have. So we've seen a lot more organizations coming to us saying we want to use these electrical skids because we don't want to build the entire building out day one. We want to have the flexibility to scale the infrastructure, power and cooling as our IT needs change.
And on the
excellent,
power side,
excellent point.
And on the power side, that same approach, when you look at the assets that are required particularly for AI, right, and the transient nature of AI, well, most generating assets are going to have a tough time with a load that swings, 30, 40, 50% in a millisecond. So one of the ways to address that is through battery storage. Well, if you have a 50 megawatt power plant, you need a 50 megawatt battery. But if you only have a 10 megawatt power plant, you only need a 10 megawatt battery to address that. And that battery only needs to operate for, seconds, not hours. So the cost, savings associated with this modular approach and stage-wise approach gives significant benefit when you're looking at, scaling up using the existing infrastructure. Is very different than it was 5 years ago. I mean, everybody knows that, but it's actually different than it was 5 months ago. So yeah, the times are changing.
So Paul, what role do you think prefabrication, I mean, you were talking about modular skids earlier, right? Maybe you could go a little more detail on what they are exactly for our attendees. But in my opinion, I think the prefabrication of modular skids is playing a huge role in accelerating deployment. What's your opinion on this, Paul?
Sure. So beyond the fact that it allows you to, scale and only maybe do 10 megawatts and do 10 megawatts later, it also allows you to do, the term offsite manufacturing. So you can be doing the site civil work, getting the site ready. At the same time, you're already manufacturing your electrical infrastructure. And one that de-risks a couple ways. One, the amount of labor you need on site. If you're using prefabrication, you can reduce that by 60%. So if you're in an area, Dallas, Texas, Virginia, where electricians are just very difficult to come by, if you can reduce that electrician demand by 60% because you did the fabrication and testing at an offsite assembly location, that can help you de-risk. And then just the fact that when you're doing the offsite fabrication, prefab, you're doing it in a climate controlled environment. So you don't have electricians out in 20-degree weather, 10-degree weather, 110-degree weather. And so that just reduces the workload. So instead of a job taking, 24 hours of labor, it might only take 10 because of the climate conditions. So all those factors just lead. The biggest one we've seen is just we don't have enough electricians, enough trades folks, or there's so many trades folks packed into a small area. If you can just slide in an electrical skid, it's already been tested and ready to go, except for the final testing. That really can help a general contractor and the client de-risk their project.
Excellent point. Excellent. Dino, I'll put this one over to you. Chuck mentioned this briefly a few minutes ago, but Dino, how do you see the current limitations in supply chain affecting the development of data centers with your clients?
So that's going to be the other kind of overall planning here, because whether you're looking at the power sector and how tariffs are affecting costs, tax policy, at some point in time you may end up contracting with baseload power generated by natural gas, but over time you may want to include a greening factor where you are utilizing solar, wind, other types of renewable energy to augment your power needs, and essentially have, as part of your overall power procurement policy, a greening, as you will, of those electrons, and that's just kind of being a good corporate citizen, making sure you control the narrative in terms of, how AI data center development, is going to affect, climate change, what the carbon footprint of the ultimate end user looks like, not just in the US, but, globally. You're, going to be judged by your overall action. So, in some cases, even if there may not be an immediate need to control your carbon footprint because of changes in federal regulation, as we've seen in the US, over time, as some of the large players in the market are being judged globally in terms of what they're doing as a corporate policy, especially in Europe. And they're being looked at in terms of what are you doing from an energy standpoint, what are you doing from an infrastructure standpoint, as your overall development strategy. So this all comes back to what types of agreements you're signing up to, because in the current PPAs that we're seeing, there may be a provision that's included for adjustments in terms of the tariff that you're paying. And that's take into account changing tax policies, changing tariff policies that may affect, the cost of the infrastructure being developed or being operated somewhere down the road as you're looking at spare parts, O&M, everything that goes into the business of producing power, of delivering other types of infrastructure. So again, it's going to be a very holistic view that one needs to take in this development. And the challenge, I think, for a number of the big tech companies, although some of them are extremely sophisticated in terms of infrastructure development, they have massive energy teams embedded within the company itself. They have large infrastructure development teams because they've been doing this for a while. But then you also have some of the big name new entrants into the market where they haven't been doing a lot of their own infrastructure build out, and they're having to come up to speed to figure out, what does it take to build out large infrastructure. And that's, again, where, they turn to advisors and they're able to kind of map out the risk on the front end so they're not caught by surprise kind of mid-development, as, they kind of learn about infrastructure development risk from their consortium partners.
Well put. And as we know, right now, the laws are changing almost on a weekly. I've never seen our government work so diligently at changing laws in my 25 years in this business. But I have a new job, and that is chasing what laws are changing.
Well, and that's critical, because depending on the state jurisdiction that you're planning to develop in, your data center or your power plant, we're seeing this in Ohio, we're seeing this in Illinois, we're seeing this
Right.
In Texas and California. All the legislatures are putting this front and center in terms of, how the interest in the market is going to affect their own existing infrastructure. So whether that's the power sector, water needs for a particular state, data center development is a critical factor in terms of economic development. And everybody wants to be included in that economic development. But at the same time, it's also putting additional stress on what otherwise is already a fragile system. And again, looking at the power sector, whether it's transmission, interconnectivity, cost in terms of ratepayers, who's going to be left holding the bill at the end of the day. How do we do this in a thoughtful, egalitarian manner where you don't have any of the free rider issues that, you'll see in the press where, big players are coming to town, and, there are issues in terms of the strengthening of the grid, investment that needs to go into additional transmission or distribution, and who pays for that, and ultimately who benefits.
Correct.
The infrastructure that is built out.
And
put.
Fernando, just building off of what Dino just said real quickly here before we move on.
Absolutely.
When we look at the limitations in supply chain, and what that does for, the development of data centers. Obviously, when you look at energy efficient equipment, you like to roll that and other technologies out because, again, that's the now and the future, where we can take advantage of newer systems to operate more efficiently and effectively. However, if I'm an owner, operator of a data center and I want to lend on a current build for my new build, if I don't have newer technology that's being rolled out, what happens to my data center that I have to look at that I maybe want to use as collateral? Those obsolescence issues in older technology, let's say, or older systems, that negatively affects my value of that currently existing asset or operations. So that's a consideration. We want to get these new technologies up and running. So once we get past supply chains, of course, it'll obsolete what's there, but what's there, we have to keep in mind that as these technologies are not being rolled out or eventually coming out, it's going to lower the values of what we have in place already.
And one thing to add to, what Anthony's saying, and again, I'm sure you're seeing this as you're building your valuation models, but the cost factors are changing on a daily basis. With whether it's
I'm involved in five projects specifically for data center, and it's as if I'm starting over from scratch on all five. And so yes, you're absolutely correct.
Well, a good example is, where you're looking at M&A and making sure that you're pricing all the additional costs that are coming out of legislation, or if you're doing the development, what additional costs one needs to factor in as you're kind of building out your costing model. I mean, we just saw this in Texas with the 89th Texas legislature when it was in session. We were tracking 100 bills on a daily basis. And we had clients that were in the throes of M&A transactions where they needed daily input into their models to making sure, the bills that looked like, they were going to pass or started getting some legs, even if at the beginning, it was more saber rattling. And then towards the end, more people started nodding, saying, hey, maybe we should take that into account. And maybe this has a chance of passing. But all these cost inputs were critical in making sure that you were properly evaluating your M&A transaction, or if you were going to financing, that the true cost of whatever build out you had was embedded in your financing models.
It's always difficult, when you incorporate model.
Hey, Chuck, you may want to try to turn off your camera because you're coming in and out. See if that works a little better.
Let me try that.
Okay.
It's always a challenge when you put when you incorporate policy into your pro forma. That's a risk that is, subject to change every 4 years or every 2 years, depending on the election cycle. But there are additional revenue streams that are also, part and parcel in the investment, particularly on the on-site power generation. If you incorporate a grid connected solution where you could sell power back to the grid and you can participate in ancillary markets, that's real revenue that, gets into your business model. That is, not subject to change as quickly as the electoral cycle. So it's a double-edged sword when you're looking at that.
No, excellent point. We're going to move on. So Akash, going back to energy storage technology, changing the way data centers manage their supply and performance. What's your opinion on this?
Yeah, this is emerging as a very important part of new data center builds, and good to discuss a little bit more of the technology side here. Basically, there are 3 levels at which energy storage is coming into data centers, especially driven by AI. So one level is very close to the AI equipment where all the GPU computations happen. There are very wild and very synchronized fluctuations in power demand. And traditional power distribution within the data center cannot deliver that kind of fluctuation seamlessly. So you go into delays and you go into energy wastage which reduces the performance of the AI and also costs more. So there are solutions coming up. For example, some equipment comes with electrolytic capacitors in them to kind of ride the fluctuations. But the best solution is a distributed, disaggregated energy storage unit close to the AI equipment, which will absorb all the GPU fluctuations. So that's one level. The second level is the UPS itself is changing quite a bit. It used to be something on the side attached to a data center, but now it's becoming part of a sort of energy and power flow in the data center. So it's much more active and can absorb fluctuations both from the GPU side as well as from the grid side. So again, here you're seeing distributed, disaggregated energy storage to, on the one side, absorb GPU fluctuations, and on the other side, absorb grid degradations. And then the third level is in the grid itself, where more renewable power is coming in. People are putting in grid level energy storage BESS for evening out the renewables and stabilizing the grid. So what is happening with all of this is, especially if you do power management well within the data center, you can have very different contracts with the utility. You can tolerate much lower SLO power from the grid, and that reduces your cost, increases and reduces the time to delivery because it is faster to get less reliable power than more reliable power from the grid. And from the technology side, apart from storage itself, we need sophisticated networked power control systems that can distribute power seamlessly within the data center and enable all of this innovation.
No, well put. And that kind of, I mean, that pretty much almost answers our next topic here, which would be specific to grid flexibility and power availability. Anything else you'd like to add
I think
about those two?
Yeah, thanks for that question too. It's slightly different. I mean, it does cover that, but like someone mentioned before, today, the default source of power is the grid. Of course, a lot of people are going to behind the meter and all of the above approaches, including smart modular reactors and all kinds of things, right? So all of that is happening, but grid is still the go-to source for most. And there are some startups that are doing very innovative stuff, like a lot of grid contracts are long-term and very like they don't consume as much as they're contracted. So there are startups that are optimizing the grid usage and minting power through oversubscription of the grid, for example. And that means you can get interconnections at a lower rate and faster. Basically, the contract between the data center and the grid is evolving and becoming much more flexible because of change in the data center itself through energy storage, as well as change in the grid through all these oversubscription kind of approaches. So yeah.
Very good point. Thank you. Dino, you talked about this a few minutes ago, so maybe dive just a little deeper, not too much on power purchase agreements. Power purchase agreements have always been essential and will continue to be essential, especially in this space. What should developers and financiers really understand about structuring these agreements? Give me like the top 3 main points on this.
So first and foremost, the data center can never go down. So making sure you have baseload power. I mean, that's first, last, and only consideration. But again, looking at a greening solution, because eventually, you are going to be judged by your power usage. I think somebody was mentioning, for PJM as power prices increase, you don't want the market to look at you. You don't want public opinion to look at you and you be seen as the reason, why power prices are going up, and who does that affect? Just like the eggs, eggs go up a little bit. I have no idea if that was true or not, but at the end of the day, that became a big story. So making sure that you are providing for your own power supply is going to be critical, that you're not essentially eating up the reserve margin, available. But at the end of the day, again, it's going to be something that you bring in advisors early on to make sure that you're not going to be in a situation where you're learning things as you go. All this is remedied by planning ahead of time and making sure that your PPAs are resilient, that they're providing for what you need in terms of your own aspects of your development. But again, it's an ever-changing market. We are seeing more flexibility in terms of what the market's providing, but making sure that you're developing your own energy strategy as part of your overall data center development strategy is going to be critical for everybody.
Excellent. So our first webinar and this webinar have been focused on the infrastructure and power generation requirements for data center projects. It's my understanding that the newer equipment that's going into the racks comes with AI and sometimes crypto mining built into that equipment, which is increasing the power demand on a per rack basis, which is the reason why we're talking about developing these large infrastructure projects with behind the meter power generation. We'll go with Paul, because Paul, you mentioned this earlier. What's your general thoughts on this?
Yes, I think the uncertainty on clients on what rack densities they want. And so I think there's a huge push. You see a lot about liquid cooling, but the reality is if you just want GPUs, so one of the things we do is we try to work with some of our other partners to educate our clients on, you can get air-cooled GPUs and you can air-cool racks densities, 50 kilowatts, pretty easy. There's some technologies out there, you can go up to about 75 kilowatts per rack. So in that case, you may not need to do liquid cooling, which injects some additional complexities and even more challenging power requirements. So I think knowing that, I think the other piece that, and Akash kind of hinted to this, is we're seeing more direct DC to the racks, so you're not converting AC to DC and back. There's a lot of inefficiencies there. The other one is solid state power electronics. So if you go to silicon carbide, that is better suited maybe to handle some of the GPU transients that Akash was talking about. And even liquid cooled power electronics that are supplying that power. We are seeing that that's eventually coming. As you think about a 1 megawatt rack and the density of that, the power electronics have to scale with that. And so keeping up on those technologies while not getting too far ahead. I think the clients making sure everyone understands, hey, you can still get GPUs, you can still get AI. It doesn't mean you necessarily have to go to liquid cooled. So I think there's a balance, and it's changing so fast. I just like the power changing, the laws change every day. I think it's almost every day we're changing. A client will say, no, actually I want 50% liquid, 25, 50% air, and it's changing all the time. So we're having to stay on top of both the power infrastructure changes, technology changes, as well as what's the right mix of air cooled and liquid cooled for the client.
Excellent point. Excellent.
Fernando, as we look at the density increasing and the requirement to go to liquid cooling, one of the other things that we'll see is that when you're doing your own on-site generation, there is the power of covering that heat energy of your on-site generation and using it to produce chilled water through absorption chilling. That reduces total energy consumption by about 1 kW per ton. So if you have 1,500 tons of cooling, that's 1,500 kW that goes back to the rack as opposed to being used for cooling. That's a significant savings, and it really pushes PUE in those instances sometimes below 1.
Good point, Chuck. Thank you for adding that additional piece of information there. So once energy strategies are in place, the question becomes, how do we actually build and scale these projects effectively? So we're going to dive into construction approaches, in scaling models. So not all data centers are created equal. Some are hyperscale campuses, others are modular facilities designed for rapid deployments. We have on-site power, cooling solutions, which we just talked about. Chuck just brought that up, redundancy, and connectivity. All of these things play into how developers balance costs with resilience. So Chuck, going back to you, can you walk us through the advantages and trade-offs of on-site power and scalable energy solutions?
Well, I mean, obviously, the propensity of the customers want grid just because that was what they've always known. But in this new vacuum where, the grid isn't available to the volume that they want,
Right.
really have to start to consider new options. And, they have to decide, well, do I really need N+2 redundancy, or is N+1 good enough? And then when the grid becomes available, how does that affect my overall on-site power generation strategy, both power and cooling? As I said, on the cooling side, you now have the ability to have free cooling as a byproduct of your electrical generation. So, that's got to be factored into your calculus somewhere. But is it N+1? Is it N+2? Is my strategy to eventually become 2N? I have a fully operating power plant that is now redundant to a fully connected grid. And what do I do with those assets? As I mentioned a little earlier, now you can look at going into, the ancillary markets and selling power back to the grid. So the strategy has to be a long-term strategy, considering what your redundancy plans are and what your plans are once you get to the grid.
Thank you, Chuck. Capital efficiency. This is always a concern for investors. So how can modular approaches de-risk large data center projects while still providing flexibility for future growth? Now, we did talk about this just now. So Paul, if you have any additional comments on this, would you be able to provide that?
Sure, and I'll answer one of the questions that's in there, and I think that'll add to it. So one of the question was about, if I have 10 megawatts and I go 10 more megawatts, what should I procure and not procure? And I think one of the things we do with our clients is we look at fungibility, and we say, okay, if the first 10 megawatts is all air cooled and then the next 10 megawatts is half liquid cooled, what components are the same that you could use in both of those situations? And then we look at what are the long lead time equipment and how is that changing? Obviously, the electrical infrastructure is probably, when you're talking medium voltage switchgear, that's right now, that's the stuff we're seeing the longest lead. So that's stuff where we have much more in-depth discussions. And then the third factor we look at is the, is there a shelf life? So if there's a long lead on something, you procure it and you're going to store it, but it has a shelf, it can potentially have a shelf life or negatively impact the equipment if it sits on the shelf too long. Then we factor all those things in as we're scaling the sites. The modular piece is, it really comes down to, we look at each site and we say, what are the trades available? What are the risks to that site? What is the client, like Chuck talked about, if I can get 10 megawatts up and running and it's generating revenue, because I don't know the next 10 megawatts, what I want, what my clients or what I may want if I'm like a co-location or a hyperscale. So we factored that in to the site. And then the other one is just where are economies of scale. So does it make sense to pour concrete and make the whole concrete pad for multiple locations at one time? That'll really depend on the location. So we spend a lot of time with the client looking at where does it make sense to if you're going to build out the whole site, where does it make sense and what can we lay and do in advance, like underground piping and fiber and things like that. And then where are other things like maybe buying generators, maybe we don't do that. I'll buy all those up at once because potentially those have shelf lives and those are huge capital expenditures. So we balance that with the long lead time.
And how do you factor redundancy systems integrating into modular designs?
Right. So Chuck can talk to this one well too. So one of the things we look at is we look at the scaling and the phasing, and we say, okay, we want N+1 and we're going to build a second phase. How can we take advantage of the fact that we're building? So maybe we go to, instead of a 2 megawatt generator, maybe we go to 500 kilowatt generators. And now, so the next phase, we can take advantage of the smaller number and have the redundancy there. So there's a lot of things we consider. It's really, we sit down with the client, but there's one of the things we're seeing is we go use smaller equipment, and that allows us to get the redundancy through that, vice having to buy these bigger generators and things like that. So those are all factors that we consider.
Excellent.
You're looking at that, in that redundancy factor, you start to see economies of scale, right? So if I have a 2.5 megawatt engine in a 10 megawatt block, I need one engine to back that up for N+1. I need two engines to back that up for N+2. But on my next 10 megawatt block, do I need another two engines? Because I've already got a spare maintenance engine and a spare failure engine to back up 10 megawatts. It could easily back up 20. So now when you get to, you really need to think through your overall development strategy. And one other important piece that you really have to spend time thinking about up front is the implications of permitting and interconnect, and how the utilities that you're working with affect your timeline and time to market. Do you want to just go off the grid and add, the ability to interconnect at a later date, so you're not subject to the utilities interconnect terms and conditions and schedule to get yourself up and running quickly? Or if you absolutely know you want to get to the grid as soon as possible, you do that right out of the gate. So a lot of thinking and a lot of forethought has to be put into your
while we are on this topic of modular deployment, I'm a big fan of modular, by the way.
I was about to ask you, Akash. So what do you see the pros and cons of modular data centers?
Yeah, I'm a huge fan of modular. Like I mentioned before, I believe in distributed, disaggregated components of the infrastructure. But you also have to watch out for a couple of things when you go modular. One is the efficiency and economy of scale. For some systems, they scale much better if they're bigger. It could be power generation, or it could, for example, think of smart modular reactor, right? It needs a certain size to become efficient and viable. Or it could, and it's true for various other things like chillers and anytime you have power and material flow through stuff, you get some economy of scale by being bigger. So you have to choose a module size that is, relatively efficient compared to the overall infrastructure that you want to build. And the second part that one has to watch out for is what I would call fungibility of the use cases. So just to give you a counter example, until say 3 years ago, most of the data centers, like Paul mentioned, were built for 10, 20 kilowatt racks, maybe 30 kilowatt racks. And suddenly it has gone to 100 to 150 kilowatts per rack for AI equipment. And I've gone through many data centers where 70 or 80% of the data center floor space is empty because all that AI equipment has densified into 10 to 20% of the space. So the previous modular equipment may not be reusable as well in the next build. So again, how can you choose modules that are super fungible across use cases and have efficiency of engineering in them so that they don't cost too much as time passes? Also, the equipment, the facility equipment that we are talking about here has a life cycle and depreciation period of 15 years, 20 years, something like that. Whereas the IT equipment changes every 2 to 3 years, and pretty much you get a new generation of IT equipment in that time frame. So how do you keep your modular equipment usable by multiple generations of IT equipment? These are all things that one has to factor into the modules that you choose.
And when we're looking at these modules, Akash, let's talk about physical connectivity, fiber optic lines, water lines, access to water, power access, which would be the behind meter, is really the whole purpose of the first webinar, the second webinar. All of these components here are crucial layers. How should developers weigh these factors when siting and building their designs?
Yeah, it's all of the above. Basically, you need power. Power is the primary consideration and the most bottlenecked, scarce resource right now. So you definitely need to have a strategy for acquiring power. Cooling, water for cooling was also generally quite important, but there are other techniques like Chuck was mentioning about heat recovery for power generation, or some other ways that you can use, adiabatic cooling or other ways of cooling, in which basically you're trading power and cooling, right? You can use more power to run more heat pumps to reduce your water needs for cooling. So there's a trade-off that you can do. And fiber connectivity is obviously super important. There's no point in having a disconnected data center. But it turns out that in the overall scheme of things, the cost of fiber connectivity is maybe 5 or 10%, not much more than that. So in the worst case, if you're building a big data center, you just invest in the fiber connectivity infrastructure if needed. Now, what happens there is the lead time can be very different for fiber, especially if you need to dig trenches for transcontinental fiber, or you need to do submarine cable laying or something like that.
Right.
Those have long
Or
lead times.
interconnected to a backbone, right?
Right. If the backbone is not there and you need to develop the backbone, that takes a long time.
Mhm.
But but if the backbone is there, then I don't think fiber pops up to the top, because you can generally get that connectivity within the time period of your build, unless you need to dig trenches or lay submarines.
And one last question for you, Akash, before I move over to Tony. So what should operators keep in mind for data center security as these systems become more and more distributed? Because as we all know, I mean, historic data centers, they're pretty much a compound. Nobody's getting anywhere near or around them unless you belong, right? But and now we have them popping up all over the country. So give me your thoughts
Yeah.
on security.
No, security is a very super important topic for data centers in multiple ways. I think I look at it as two axes. One of them is the physical security to the asset itself, and the second is security of the digital assets, the data, etc., in there, virtual security. And the second axis is security of the facility itself and security of the IT stuff that is in there. And so if you think of this, for physical, in all of these cases, essentially you have to follow zero trust policies everywhere. Basically, you can't trust anyone who's able to touch any of this stuff. So you need to have the right levels of access control and the right level of policies for excluding people based on their roles and the jobs that they need to do in very specific use cases. So in physical security, it's just access to the buildings, access to the data halls, the equipment cages, machines, data storage, etc. And that is, there are well-defined protocols for controlling access in the physical environment, which should be followed. Then there's network security that starts to get to the first layer of the IT security. And in the network security, you're basically segmenting your digital infrastructure into regions that only certain people with certain permissions can access. So this could be segmentation by customer, segmentation by location, segmentation by kind of data, whether it is private data or not, etc., within their personal data, etc. There's also, the next level of security is most of this IT infrastructure is shared. So multiple jobs from multiple departments or multiple customers even could be running on the same machine or in the same block. And sometimes there are OS vulnerabilities that can look into data that is on the machine that doesn't belong to you. So then you need to have partitions and protections for sort of this vulnerability attacks on the machines and the storage within the data center. There's also denial of service attacks from outside that start to swamp the data center resources, and you need perimeter resources to protect against those kind of attacks. End-to-end encryption is another very important strategy that is used. So basically, no data, whether it is in storage or in the compute or in transit, is exposed without encryption. And how to manage this highly scaled encryption key infrastructure and the control plane scale for doing that is huge, as well as the performance requirements for doing that. It might even add something like 5 to 10% extra power to the whole data center. to be able to manage encryption across all these use cases. So these are some of the techniques that are used for security, but obviously security is super important. I mean, yeah, for all the obvious reasons.
Agreed. Agreed. So Tony, we've talked about a lot of different things here. We've talked about power generation, power plants, power generation, modular units, utility scale units behind the meter. We've talked about power feed wiring, air cooled versus liquid cooled. We've talked about the racks, the data centers themselves, the fiber that has to come on, site, water that has to come on site. So Tony, from a machinery and equipment perspective, what role in your opinion does cost segregation studies play in optimizing the economics of these projects?
Oh, it plays a large one, all right. So first, let's understand what a cost segregation is. You know, it's an opportunity for a facility owner and operator to componentize the building assets, you know, normally depreciated over 39 years into 5, 7, and 15-year buckets for, you know, federal tax purposes. So, you know, you want to take advantage of that accelerated depreciation, which at the end of the day lowers your taxable income. So how does that translate into a data center? Well, Fernando, you mentioned before, you know, historically, you know, these data centers are compounds. Well, they're not going to be compounds anymore. And, you know, Akash brought up a good point when he was talking about, you know, modular DCs. You know, at the end of the day, when you think of a data center, you wouldn't want to build a data center for millions of dollars and for federal tax purposes on your tax forms, you know, depreciate everything over 39 years. You want to get some of those, you know, assets, especially, you know, let's talk about, you know, your networking equipment. You know, you talked about power feed wiring. You know, there's certain electrical distribution components you can get into 5 and 7 year, you know, depreciation buckets. There's also racks and cabinets. You know, we talked about PDUs and switch gears. You know, as a tax planning strategy, you want to get that cost segregation done for a new build right away so you can take advantage of this accelerated depreciation. Now, talk about renewables, okay? Renewables on site are already a plus for the developer as well as the, you know, the eventual owner operator. Why? Because, you know, we're talking about 5 and 7 year depreciation buckets. Well, renewables like solar panels, BESS systems, if you have any EV charging stations, you know, not only are they 5 years right off the bat if you're doing a cost segregation, remember, these are also qualifications for ITCs. You know, these are all positives and things that owner operators need to think about once they get the new build in, whether or not it's a new quote unquote compound or a modular system, as Akash was talking about before. But also remember, you know, lastly, that, you know, with the new passing of the One Big Beautiful Bill, you know, you have qualified property, which is defined as, you know, it's maker's property, which is, you know, 20 years or less in terms of a recovery period, or even, you know, let's consider qualified improvement property, i.e., you know, if you have a redo for interior lighting, floor coverings, this qualifies as qualified improvement property. You could take advantage of getting those assets into those, you know, accelerated depreciation buckets right away. But remember, with this, you know, with the new One Big Beautiful Bill, you were limited before January 20th, 2025 to only take advantage of, you know, 40% of that QIP or qualified improvement of being 40% bonus depreciation. Now it's all 100%. So it all interplays with each other, and it's a home run.
Absolutely. Well put. And that really does have an impact on economics, do you think?
Absolutely. You know, it has an economic plus for, you know, tax planning, federal tax planning purposes. And just to bring it all back to, you know, what we talked about, you know, ad valorem at the beginning part of this forum, you know, these tax strategies that you want to think about, both from a state, local, or SALT perspective, as well as a federal perspective, they all come into play, not just for new builds, but also if you're doing any rebuilds of, you know, not of brownfield properties, which we touched upon in the middle section of this forum. You know, these are all considerations that you have to think about from a tax planning perspective, not just today, but also 2, 3, 5+ years down the road.
Excellent. Thank you. I'll open this up to all of the panelists. Are there any other what other construction or scaling innovations are you seeing that will define the next wave of development? I'll
Fernando,
open this up.
I had one thing I wanted to add.
Sure.
You know, a topic we didn't cover is the value of time to market. You know, so right now, if we're looking at a window of 3, 5, 7 years out for my plant to come online with grid power, it's affecting my decision on what I want to do around on-site generation. If I've made a $1 billion investment in chips and they're sitting on a shelf doing me no good, what would I be willing to pay to get to market, you know, 1 year, 2 year, 3 years earlier? And this goes back to the one of the comments that Akash made. Yeah, ideally, I would love to build a power plant that's got, you know, 2 50-megawatt engines because I get the economies of scale associated with that. You know, then the next window for getting a 50-megawatt engine is like 2033. So, you know, now you have to start making accommodations and accounting for, all right, how do I get to market as fast as I can, delivering the same resilient power solution and the fastest amount of time so that I can monetize the investment that I've made in my billions of dollars of chips. And it affects the decision, which is really what's been driving us down towards this modular and compartmentalized design, because the first thing to go was all the big turbines. Then the next thing to go was all the big engines. All right, well, what are we left with? What's in the market and what can I get in a 12 to 20 month time frame? So now we're down, you know, in between 1.5 megawatt engines and 5 megawatt engines. How do you box those together and package them so that you could get to market faster? Because, you know, in discussions that we've been having, utilities data center operators are saying, well, yeah, if you could get me to market 1 year faster, I'd pay a levelized cost of energy of, you know, an additional 10 cents. If you could do 2 years faster, I might pay you 20 cents. So, you know, that all affects the decision matrix when you look at the value of time to market.
Yeah, I want to second this point. Time to market is super, super important and is perhaps the most critical driver of all of this investment. Because, I mean, why are all these major companies investing so much into data centers for AI, right? Because the faster they can churn out their models and improve their performance of their AI systems, the more revenue they can bring in, or at least stave off competition for now and then bring in revenue later. So time to market and the speed at which you can deploy data centers is very, very important. Now, one thing I wanted to mention, though, that like I mentioned at the beginning, the inventory that you hold has to be graded by the time that it takes to deploy it. So, for example, you would not invest $1 billion in AI chips unless you have already the footprint into which to deploy them, because you know, it's just too much money to hold for not having the ability to deploy them. So basically what people like to plan is, for whatever is a long lead time item, you try to make it as fungible as possible and try to delay holding inventory of expensive things as much as possible. So you invest a lot in the beginning in highly fungible assets. That could be power, that could be fiber, etc. And then when it comes closer to delivery and deployment time, you start holding chips and other expensive IT equipment. Generally, the machine deployment happens within the last 3 months, 6 months, at the most 1 year of when you place orders, because you don't want to hold billions of dollars in inventory over there.
Great comment, Akash. As we're moving towards the end of the webinar, Paul, do you have any closing thoughts you would like to address?
No, I think we covered everything. I appreciate it.
Dino?
Yeah, I mean, again, I think just making sure that you have a very detailed overall plan. You know, I always say that any project without financing is a dream, and is a nice whiteboard exercise. So making sure, you know, you're also starting with your lenders, making sure what their interests are, seeing what else is being financed in the market. There's no need to reinvent the wheel. There are wheels that are already out there. There's no need to take on risks that isn't in your core business. So there are definitely partners out in the market to build consortiums with. Have everybody do what they do best, But again, as we started this discussion, a chain is only as strong as its weakest link. Right now, there's a lot of movement in the energy sector. There are people leaving it. There are people that aren't going to be around by the end of year that weren't as well capitalized as others. So making sure that you're picking partners that are going to be there for the long haul, and then most importantly, that you're picking the right advisors to surround yourself with to make sure that if it's not your core area of development, that you are bringing people that have done it before. I co-lead our AI practice. I co-lead our data center development initiative. And then in my role for project finance, I'm seeing a lot of the energy development. So I've been in a lot of different forums. Unfortunately, sometimes it becomes an echo chamber in and of itself. So the energy people are just speaking energy, but they're not getting to the tech companies. I'll show up at a data center event, and just chaired one a few weeks ago. When you were looking around, all the pieces to the puzzles weren't in the room. They're at some other event, speaking to their own needs. So just making sure that there is a lot of cross communication, amongst all the different components in your development, and then you're assured at least you'll have a greater degree of success in your own development.
Well put. And Tony, any final comments before we move into some questions that we have?
Yeah, real quick. I like what Dino said, because it kind of reminds me of one of my favorite sayings, which is, if you're the smartest person in the room, you're in the wrong room. And you need to, from a valuation standpoint, when we do our appraisals, there are so many things we have to consider. So when you look at the topics that we covered on this forum as well as the last forum, developing a valuation or an appraisal, for financing purposes, insurance, cost segregations, there's a lot of moving parts. There's a lot of pieces. So, the one thing you want to make sure is that everyone on the team is talking to everyone, so that this way you're covering all your bases, because the one thing you don't want to do is miss a mission critical material piece, of the puzzle, so that this way, especially and I say this from a valuation perspective, looking at it through that lens, you don't want to miss something that's a key value driver that can take the appraisal of your system or your assets from X to Y. And I don't mean an immaterial amount of 5-10%. I'm talking about 50%. So when I talked before about functional obsolescence, depending on what types of systems you're looking at or what types of technology, considering Gen 5, to fourth generation or fifth generation as compared to first generation, that's a big driver, and that's a big miss if you miss it. So make sure all the teams that are all working together are talking to each other, so you can identify these pieces.
Well said. Well put, Tony. Thank you so much. As we move into some of our questions, if we haven't addressed your question, we will definitely address it via email after the webinar. So one of the first questions that we have for the panel, and Chuck, I'll let you go first on this one. Who ultimately makes the engineering decisions for behind the meter energy and grid interconnection? Is it made by the data center operator, or is it made by the developer of the power plant, or are they one and the same? And I really like this question, because it's two completely different industries. One has nothing to do with the other. So they just need each other. So what are your thoughts on this, Chuck?
Well, I've often found that whoever pays the money makes the decision. So if it's the data center and they're paying for it, they're making the decision. If it's the developer and he's paying the money, he's making the decision. Now, ultimately, through an ESA or a PPA, the data center operator is making the decision. But the return and the capital deployment, through a third-party investment vehicle, is going to significantly influence how that decision is made. And there's going to be a long and drawn out negotiation associated with what's included in the delivery of that power. But ultimately, whoever the golden rule, whoever has the gold makes the rules.
Excellent point.
I can jump in. I mean, completely agree with what Chuck just said. Whoever has the money pays for it. But Let me give you a bit of a hyperscaler perspective. I just came off 10 years at Google in technical infrastructure. And obviously, Google develops its own, full stack of, capabilities for developing its own data centers. I would say that there's a layering even within a company like that. So there are teams that go and, first of all, it's all driven by forecasts. There are long-term forecasts, short-term forecasts, and so on. And based on these forecasts, there are different teams at different levels of the stack that look at resources. Right? So there is a team that looks at which geographical area do we need to go into and what resources do we need to get or have over there in order to build the rest of the stack. So there would be teams going out for areas with access to grid power, especially green grid power, areas access to natural gas, with areas that permit smart reactors, etc. Right? So there's that team. So I think that team is independent and does its own thing based on long-term forecasts. And then the next layer of the stack comes in and says, okay, we have already acquired these geographical resources. Now this is our timeline for building facilities at different resources based on demands that we see at different locations. So that's the facility. So if you compare this to industry, the first team is sort of the resource acquisition team, and the second one is the facility or data center developer / operator team. And then the next teams come on top of that, which is who wants to deploy IT equipment or what flavor, etc. So I think it's a shared decision between where the resources are available and which facilities to develop based on long-term forecasts. And now how valid those forecasts are will, of course, depend on various other market conditions, but that's how I would look at it.
Thank you, Akash. I'm gonna bring this out to. I have another question. Paul started answering this question earlier, and I'll bring this question up to Paul, Dino, and Chuck. And if you can give your thoughts on this, we'll start with Chuck first. In the context of building in alignment to future scalability, such as phasing a project in 10 megawatt power blocks, are there some building systems that should be procured on the front end in phase one for all project phases to save escalation costs, while other building systems equipment should wait for the next phase 10 megawatt increment to move forward as the technology is evolving so quickly that procuring it early would result in outdated technology? So Chuck, what's your initial thoughts on that? That was a little mouthful, but.
So like Paul said, there's some things that you want to do that are going to be ubiquitous across the entire site. You want to do all your trenching. You want to pull all your cabling. You want to pour your pads.
Right.
There's building systems that you also want to include. So, what your control strategy is, you need to buy a control system that's going to be able to integrate on a stage-wise basis. All of your power controls, your building controls, even your data center controls. So your DSIM that you purchase needs to be flexible and capable of incorporating those. So there's certain things that are overarching across everything that you're going to do on the site as that data center evolves that you might want to buy up front, but you don't want to invest in all of the infrastructure. You want it to be that modular approach where you buy the system, but you can add on to that system as you go on. You want to make those long and then any long lead item purchases, you really have to spend a good bit of time in your scheduling and your project management strategy on when you have to pay for it, when it shows up, and when it can actually turn on and integrate into your system, because that can be a 12 to 16 month cycle. So, long lead items and overarching systems are where I would focus.
Okay, thank you, Paul. Any final comments? I know you touched on this earlier.
No, and I think that the one thing I would consider is you really have to consider the footprint, because the amount of data hall space for 10 megawatts of air cooled at 10 kilowatts a rack is completely different than 132 kilowatt racks. And so you don't want to strand white space. So that is a consideration, something it's maybe a procurement, but it's really, if you look at a site master plan, you got to really be thinking about how, if you were to think of, just say, I'm going to do 100 megawatts and every 10 megawatt footprint's the same size. that maybe doesn't make sense. So I think that's something to consider is how are you laying it? How do you anticipate it, and where are you willing to take risks? Because you'll hear a lot. I'm hearing more about over provisioning, where you say, hey, I'm going to size for 60% liquid, 60% air, because I don't know. But that comes at, even then, that comes at some risk and just the footprint. So I think stranding the amount of stranded white space is definitely something to consider as well.
Excellent. Thank you, Paul. We're running close to the end of this webinar. So I want to give a very big thank you to Chuck, to Akash, to Tony, to Paul, to Dino, for all of the time that you have shared with us in preparation for the webinar and sharing your expertise today as well. So thank you very much to all of you. And as we've heard, data centers have always been about servers and storage, but because of the AI revolution, their power requirements are now outgrowing their current infrastructure. Access to water and power now play a critical role in the overall cost, resilience, and ultimately in the investment performance. So those are my closing comments for the day. I want to thank everybody for joining, everybody in the audience who joined us. We really appreciate this. We will be recording, this webinar has been recorded and will be available to download. So we look forward to any future conversations. Please feel free to reach out to any of our panelists with any additional questions that you may have. You can reach out to me as well, and I can get you in touch with them. But thank you very much, and I'll turn this over to Cherie.
All right, thank you, everyone. Like Fernando said, we will be sharing the recording and some key takeaways. So just look for that email early next week. Thank you again for joining us.
Thanks, everybody.
Bye-bye.
So
Thank you, everyone.